This is not normally going to be a financial information channel. However, all of us have to go through the financial world while we make our way through life. So, this video is going to be out here to help you, whether you're an 18-year-old who just graduated through high school and you're about to start making your way through it, or if you're a 50-year-old who's trying to figure out how you're ever going to be able to retire from your job. I hope this helps. Hi, I'm John with McCrazy World, and today we're going to go over what I call financial foundations. It's information that we all should have got before we even finished high school, so we knew how to deal with loans, credit cards, and the financial world as a whole, but most of us never got. We're going to go through a broad variety of topics today, but due to that spread of topics, we're not going to go to a lot of detail. I do have a longer video that we'll put up over here that goes into greater detail, but if you still need help, go ahead and drop us a comment and we'll try and get you a response. A little background on me. I've been financially independent since I was 17. I retired from the military at 37, and I'm currently a small business owner. I've taken finance, accounting, and business management courses in college, but I'm not a certified financial planner. I'm not giving you any specific investment or financial advice. These are just broad ideas to consider and to help you out. I've owned multiple homes. I've had literally dozens of loans as far as home loans, car loans, truck loans, motorcycle loans, everything under the sun. And then I've had more credit cards than I can even remember. But bottom line, I've had a significant amount of personal experience in both credit and finances. So with that being said, let's move into the 4 steps for a strong financial foundation. First one's going to be increasing your income. Second is improving your credit score. Third, reduce your spending. And 4 is invest in your future. So let's go into those in greater detail. Increase your income. Obviously, the first one is if you don't have an income, get one. Get a job somewhere making you income. Find something that fits you. Once you have a job, compete for or ask for a promotion at work. If there's no ability to earn more at your work, consider looking for a new job. Get a degree or a certification that will allow you to get more pay at your current work or to get a job that pays better somewhere else. Start your own business, either full-time or in addition to the job that you already have. There's 40 hours in a standard American work week, but there's 168 hours in a week. So there's a lot of extra time that you could be putting forward to make more money elsewhere. Start a career with benefits like health and dental and a retirement plan, and has advancement opportunities instead of having a dead-end job somewhere that will never help you get ahead. And then invest and make passive income, which we'll talk more about later on. Second item, improve your credit score. Your credit score is how banks judge you, and they assess the risk of lending you money. The worse your credit score is, the worse your loan terms are going to be. And having a good score or a bad credit score will either save or cost you tens of thousands of dollars in interest on loans when you start getting car loans and home loans. Ways to improve your credit score are improving your debt to income ratio. So like we talked about before, if you can increase your income, or you can pay off your debts, either paying off your credit cards or paying off previous loans that you have, this will help improve your debt to income ratio. There's the snowball technique, which is just paying off your lowest balance loans first. And there's also the avalanche technique, which is paying off your highest interest rate loans first. Either one has its merits. You can look them in more detail on your own. While you're doing this, Always pay at least the minimum balance due on all of your loans and pay them on time so you don't get fined and you don't start getting negative reports on your credit history. Don't let things go to collections, but if they do, don't waste your time and money paying them. That could be a whole separate video all on its own. I'm not going to go into that right now. And lastly, don't buy everything with cash. Buying things with cash may save you on paying interest now, but it will cost you paying on interest later because you will not have a good credit history. You will not have an established credit history, and you will end up paying higher interest rates. Credit cards, which are a form of revolving credit where you basically take out a small loan every month that you use your credit card and then you pay it off. And this cycle just repeats itself over and over again. Credit cards can be a good way to build and improve your credit. You get a history of paying things off. It establishes a length to your credit history. And as you get more credit cards with a higher cap on them, you lower your credit utilization as long as you're paying those credit cards off. Do's and don'ts of credit cards. You do want to get credit cards that have a 30-day grace period, and you want to pay that balance off in full each month. This will keep you from, one, running late on payments, but it will also help you avoid paying any interest at all on your purchases. You also want to get cards that have rewards to them, either cashback, points, miles on flights, etc. If you do these things, it will result in improving your credit score, and it will also earn you money or rewards back without losing money of your own. What you don't want to do is pay off credit cards late, where you end up having to pay fees. You don't want to buy things that you can't pay off that money that month and start having to pay interest on them, making them more expensive to you. And you don't want to hurt your credit score and cost yourself money by paying beyond the late day, especially getting to the 30, 60, 90 days. Always make sure you're paying things on time. Easiest way to summarize credit cards is use them wisely or they will use you. Loans. Having a higher credit score gets you lower interest rates on loans, which saves you money. This is especially true when you're doing big ticket items like cars and especially houses. Improve your credit score now on smaller items to save more money later on. Don't use cash all the time. Always shop around when getting a loan. Don't just think that your credit score automatically gets you the same rates on a loan everywhere you go. The amount borrowed, the time it is borrowed for, and the interest rate all combine to determine the amount of interest you're going to pay over the course of that loan. Just as an exercise, how much interest do you think will be paid on a 5-year 10% loan on $20,000? If you thought 10% of $20,000 is $2,000, so you're going to pay $2,000 in interest, it's a logical assumption, but it's completely wrong. A 5-year 10% loan on $20,000 will actually see you paying nearly $5,500 in interest, which is actually 27.5% interest on that loan. This is because you're being charged 10% interest every year on the entire balance that you still owe on that loan. And it adds up and adds up and adds up for 5 years. So how do you beat interest? You improve your credit score so you get those lower interest rates. You pay the principal down quickly. You can do this with a down payment at the beginning of your loan, but you can also pay additional principal in a large sum, which helps the most when you pay it at the beginning of a loan, say in the first year or two. You can also make additional principal payments every month. If you can put down an extra $50, $100, $200 on a loan, so you're chipping away slowly at that principal balance, it will help you save greatly on interest fees in the long run. And you can also beat interest by investing your money and having interest work for you instead of working against you. Let's talk about some common interest rates. Keeping in mind that $20,000 example on a 5-year loan at 10%, which is the average car loan right now. Savings accounts currently give you, if you put your money into a savings account, they'll give you anywhere between 0.01% interest, which is basically worthless, to 4.85%, which is pretty good. And that's been a pretty recent thing, just due to the fact that inflation's done what it has to the economy lately, and banks trying to stay afloat with these bank runs in the last couple of months. But at least they're finally giving a decent interest rate on savings accounts. Mortgage rates have been going up. They're all the way to 5.7 to about 7.2%, which means over the course of a 30-year loan, even on a 6.5% interest rate loan, you will spend more in interest than you will actually pay for the principal balance on that home loan. A car loan, you can get them for as low as 2.9% all the way up to 15.7% interest, but the national average right now is about 10.8% on a car loan. Credit cards, 16.7 to 30%, and payday loans, God help you if you get one, 390 to 780% is what those end up costing you. So let's talk about the third pillar to a financial foundation, which is reducing your spending. Trimming the fat from your spending, making little things add up so you have money to invest in your future is the goal here. So not buying a coffee at a shop, but instead using a machine at home can save you almost $200 a month, just one coffee a day. Getting rid of cable TV and paying for a streaming service or two can save you about $130 a month. Eating a homemade meal instead of eating out at fast food once a day saves over $200 per month. And then doing things around the house yourself instead of paying someone else to do it, such as lawn care, house maintenance, car maintenance, can also save you several hundreds of dollars. Other tips: never pay full price for major purchases. You don't have to scour coupons for every little thing that you buy. But when you're buying big things like TVs, furniture, stuff like that, it pays to shop around, wait for sales, and try and find a good deal on what you want to get. Don't be afraid to buy things that are slightly used as long as you can get them in good shape at a decent discount. And make things that you do buy last longer so you're not constantly replacing them. Vehicle depreciation curve. Vehicles are one of the most expensive things we buy other than homes, but they are an awful investment. They will generally depreciate 15 to 25% within the first year from when they're brand new. And within 5 years, they are generally worth 40 to 50% less than what they started out as. So buying a brand new car is almost always going to be a bad financial choice. If you really want to have a newer car, I highly recommend getting a car that is 3 to maybe 5 years old, that's still fairly new and reliable, still looks modern, has all the modern amenities, but has already gone through the vast majority of its depreciation curve. And that brings us to our last financial foundation pillar, which is investing in your future. Get out of a job, get into a career like we talked about earlier, something with benefits, something with a retirement. Get out of an apartment or a rental house and buy a house of your own. Now's not really a great time for that. If you take a look at the Housing Affordability Index, this is the worst time to buy a house since the 1980s. But when prices stabilize, start paying off your own mortgage instead of paying someone else's. Have 3 to 6 months expenses saved up in a savings account, and everything beyond that, you need to be investing 10 to 15% of your income into growing your own wealth. This can be a 401k if your employer offers one, especially if your employer offers contribution matching on a 401k. You need to be taking advantage of that. If not, you're throwing away free money that could be paying your retirement. There's traditional and Roth IRAs. Not going to get into the details, but you can have a IRA at the same time. You also have a 401k with your employer. You can double dip. And those are great ways to save for a retirement. You can also have a stock brokerage account, which is another way to invest in the stock market, but it's not a retirement account. So you can pull that money out and put money in however much you want every year. Bonds, savings certificates, and treasury bills. They don't tend to increase in interest as well as the stock market does. The stock market tends to go up on average 10% a year. There's years where it comes down, but on average over the last 100 years, it's gone up by about 10%. Bonds, savings certificates, and treasury bills usually average far less than that. But right now that the economy is doing what it is lately, it's actually at about 5%, which is a pretty solid investment and much safer in the long term than a lot of stock market investments are. And then there's also real estate, which, like I said, isn't a great investment right now, but depending on when you're watching this video, can be a really good investment. So I know 10 to 15% sounds like a lot when you're feel like you're scraping by, but the payoff can be huge. And let's talk about that investment. If you take $500 a month, which is less than we tallied up in the reduce your spendings portion of this, $500 a month is also what you're allowed to contribute into a IRA. You can put in $6,000 a year, which is $500 a month. What could that end up being? Well, if you put $500 a month for 20 years into a savings account that gets 0% interest on it, you'll end up having saved up $120,000. However, if you put that into a brokerage account or an IRA where your investments match the rate of return of the stock market for 20 years, then you will end up with $383,000, which is about 3.2 times more than what you actually deposited into that account. If you can keep doing that for 30 years, you'll end up with $1.14 million, or about 9.5 times what you actually put into the account. And say you're a pretty savvy investor and you can beat the stock market rate of return consistently for 30 years and you can make 15% on your $500 a month, you can actually end up with $3.5 million, or 29.2 times your actual investment. So it definitely pays off to save money. Would you give up $1 of spending today if it was going to give you almost $30 when it came time to retire? I think most of us would, but you just have to be disciplined to do it. So going back and summarizing the 4 steps of a strong financial foundation, we've got increase your income, make more money, improve your credit score, lose less of your money to interest, reduce your spending, waste less of your money so you can have more of that money to invest in your future so you can make your money make you money. That's all I've got for you today. Our resources will be posted in the description. If you have any questions or comments, feel free to leave them below. I hope you found this video to be informative and helpful. If so, please hit the like and subscribe buttons and feel free to share this video with someone you think can benefit from it.